Welcome to This Explainer. Today, we're pulling back the curtain on Dover Corporation, ticker symbol DOV. It's a seemingly boring industrial manufacturer, but it's hiding a highly lucrative secret. We're going to break down Dover using the timeless investment philosophies of Warren Buffett, Peter Lynch, and Benjamin Graham, and then run it all through rigorous discounted cash flow models to see what it's really worth. Think about it for a second. What actually connects AI data centers, global supply chains, and your local grocery store? Well, the answer is Dover. They essentially build the world's invisible infrastructure. They make the critical components that make everything else work. Whether we're talking about liquid cooling thermal connectors in a massive AI server farm, traceability software for pharmaceuticals, or the high-efficiency refrigeration racks down at your local supermarket, Dover is that quiet engine constantly running in the background. So, here's our roadmap for today. 1. The hidden industrial giant. 2. Moats and margins. 3. The cash flow engine. 4. Future tech catalysts, and finally, 5, valuation and verdict.
Let's kick things off with part 1, the hidden industrial giant. In fiscal 2025 alone, Dover quietly raked in over $8 billion across 5 highly specialized, heavily regulated industrial sectors. Their largest and most profitable division, Pumps and Process Solutions, brought in over $2.1 billion just by itself, completely driven by precision fluid handling. And because they're spread out across all these different sectors, a downturn in one area is almost always offset by strength in another.
Moving right along to part 2, moats and margins. All right, let's put on our Warren Buffett glasses for a second. We're looking for that wide economic moat, right? Well, Dover has a classic razor and blade model. They don't just sell you a machine once and say goodbye. No, they lock you into a highly sticky ecosystem. For example, once they install a barcode printer on a factory line, that customer absolutely has to keep buying Dover's proprietary ink just to keep their operations running. Imagine you're running a massive grocery chain or a high-tech biopharma lab. Changing out Dover's customized equipment is a complete nightmare. It's just too risky and way too expensive. That dynamic creates immense switching costs, which gives Dover incredible pricing power. It's exactly what transforms a totally volatile industrial equipment maker into a predictable, high-margin compounding machine. And all that pricing power, it translates directly to a massive, eye-popping 40.16% gross margin for 2025. Going back to our Buffett's lens, keeping margins steady at 40% in heavy industry basically proves that the company can pass inflation costs straight on to consumers without blinking. Combine that with a stellar interest coverage ratio of 13.16 times, meaning their operating income covers their interest expense 13 times over, and a net debt to EBITDA of just 0.94, this easily checks Buffett's boxes for manageable debt and incredibly consistent earnings. Next up, part 3, the cash flow engine. $1.11 billion. That is the free cash flow they generated in 2025, thanks to incredibly low capital expenditures. For Warren Buffett, this is practically a perfect proxy for owner earnings, the true cash an owner could pull right out of the business. And if we shift over and look through the Peter Lynch lens, Dover fits perfectly into the category of a stalwart. It's a large, highly reliable company providing steady, moderate growth and excellent downside protection. Now, because they're swimming in so much excess cash, Dover has rewarded investors with over 10 consecutive years of reliable dividend increases, with their total dividend hitting $2.10 annualized by early 2026. This hits Benjamin Graham's defensive investor checklist flawlessly. They have adequate size at a $29 billion market cap, strong financial condition with a current ratio of 1.79, and a totally flawless dividend record. And their core demand is still incredibly healthy. Looking at this recent momentum from the first quarter of 2026, their revenue actually jumped 10%, despite some really complex global economics. Strong management, executing well under pressure, is exactly what our guru frameworks demand. Which brings us to part 4, future tech catalysts. So Peter Lynch might call them a stalwarts historically, sure, but look under the hood and you'll see parts of this business are rapidly turning into fast growers. They are aggressively pivoting to capture secular growth in AI cooling, eco-friendly supermarket refrigeration, and clean energy. And a lot of this is driven by strict government mandates that practically guarantee future demand. Just think about AI data centers. Next-gen computer chips literally run too hot for normal fans. You have to use liquid cooling. making Dover's zero-leak precision thermal connectors absolutely vital for these hyperscale AI server farms. This specific niche is growing at a wild 25 to 30% compound annual growth rate, and since Dover already has a proven zero-defect history with the top chip makers, they are perfectly positioned to ride this massive tailwind. Plus, they just announced the strategic acquisition of Gested in India to heavily expand their footprint into the booming liquefied natural gas and cryogenic markets. Dover essentially uses its massive $1.11 billion in free cash flow to execute these smart bolt-on acquisitions. They're instantly buying their way into highly profitable adjacent markets without taking on the massive risks of internal research and development.
Finally, Part 5, Valuation and Verdict. The million-dollar question.
So, what is this all actually worth today? Triangulating our data, the frameworks point to a fair value midpoint of roughly $210. Our base case DCF model, which assumes steady but slightly slowing growth, yields a value between $185 and $230. However, if we apply Benjamin Graham's incredibly strict intrinsic value formula to their earnings and book value, we get a much lower target of just $85. So Graham absolutely wouldn't touch it at today's prices. And from a Peter Lynch perspective, a PEG ratio nearing 3.9 means he'd likely classify this as a pretty expensive hold. Currently, the stock is trading right around $219. That puts Dover in the upper band of our watch zone. It's fairly valued, sure, but you are definitely paying a premium for that elite quality. Synthesizing all of this together, Warren Buffett would totally recognize the brilliant economic moat and the strong owner earnings, but he'd likely wait for a margin of safety closer to $175 to actually trigger a buy. The huge strengths here are those 40% margins and massive cash conversion. But the main risk is simply that the current high valuation leaves virtually zero room for management error. Because of that, our final blended recommendation is a solid hold at current prices.
So, here is what you need to ask yourself. With their fortress balance sheet and massive AI tailwinds, are you willing to pay a premium today for industrial perfection tomorrow? Dover really is a masterclass in building the invisible, vital infrastructure of our modern world. Definitely keep it on your watch list for any market pullbacks. Thank you so much for joining me on this explainer. Keep learning, and I'll catch you next time.